Hello guys, welcome back to ESENtaxa. Andrea Papito here. In this video we are going to analyze an important topic, which is the CFC Rules, which stands for Control Foreign Company Rules. So this is a situation where you are the direct controller or direct owner of a company which is situated in a country where the taxation is low, and this company controls another company which is in the country you want to relocate in. But don't worry, I'm going to explain you exactly what it means. First of all, if you are new in this channel, if this is the first video for you in this channel, ESENtaxa talks about the taxation, Italian taxation mostly. We explain how to optimize your taxation, and if you have let's say a structure, company structure, we provide consultancy services to understand if the relocation to Italy makes sense for you. We also provide a tax assessment and tax simulation to see if your net in your pocket makes sense and the relocation in Italy, of course, makes sense for you or not. We also talk about tax strategies and how to pay less tax possible, even though if you're an individual, not just for company owners, of course. In this specific video, I want to discuss about the CFC rules. So the CFC rules is a situation where, and I'm going to explain you exactly the scenario, we want to relocate in a country. For this case, we have Italy, for example, but we are living in a country in which we have, for example, a holding company. So we control a holding company. So we are basically a physical person, an individual that owns a holding company. And this company basically controls one or two companies. Company number one, company number two, okay? Most of the time, this kind of structure, especially for big companies, for big entities, it's made in such a way that the holding company is set up in a country where the taxation is quite low, while the companies, the company below, controlled by the holding one, are set up in a country where the taxation is higher. It's a classical situation. And then this kind of structure allows to the groups to transfer money to this holding company where the imposable income is taxed at a lower rate, or some cases at zero rate, okay? While the imposable here, the income, the profit of these companies are taxed at a higher rate. For example, if you have a couple of SRL running a business in Italy, the corporate tax here would be at 24%. While if you have incorporated a holding company in a country where the tax rate is 0%, with some mechanism of transferring your values, your money, your profit into holding, allows you to reduce the profit here, make it like just a cost, and then this company basically pay nothing on the profit because you managed to squeeze the profit to zero, while the holding that has a zero taxation or profit tax can benefit from the, let's say, from the net profit coming from the control of the company. So the OCSE countries, to avoid this kind of schemas, to avoid this abuse and avoid to see their taxable income completely close to zero and don't see basically their taxation applied, they've implemented the CFC rules. So the CFC rules are intended to avoid this kind of situation, this kind of scenarios. But the CFC rules actually cannot be triggered always. There are some certain scenarios that the CFC rules can be applied, and if the CFC rules applies, it means that even though the holding is incorporated in a country, in a jurisdiction where the tax rate is zero, unfortunately you have to tax the profit of this holding at the same tax rate of the country where the physical person is situated, okay? So if the individual is fiscal resident in a country where also the lower companies are situated, are incorporated, then also the holding company has to pay the tax rate because it triggers the CFC rules. So this is generally speaking how it works. Of course, each country implements them in some slightly different way. Europe has followed two kinds of module of implementation, module A and module B. So let's move a little bit forward on this kind of concept, and let's explore what does it mean module 1 and module B, module A and module B, I would say. So first of all, we have the module, the CFC rule applied with module. This means that if your holding company is incorporated in a country where the taxation is 50%, so the tax rate the profit tax rate is incorporated, the entity is incorporated in a country where the effective tax rate is 50% less of the fiscal resident of the controlled physical person, so from the person that controls the holding company, and all the income of this holding company is passive income. So if those two things are applied, are verified at the same time, then the CFC rules are applied, and your holding company, even though it's in a jurisdiction where the profit tax is very low, has to basically, we have to tax the profit in the same way is taxed in a country where the individual that controls the foreign company is fiscal resident. Okay? So this is how it works. There are certain countries in Europe that apply the Model B, which basically says the CFC rules are applied if the holding company that we have seen before is just let's say, a box with no real economical substance. So basically, the holding company is just a box that is used to pass the profit tax. It's not really something that is used to run a business. Okay. So if this condition is verified, the country that can trigger the CFC rules on this company controlled by a person that lives, by an individual that lives in one of those countries that applies the Model B. Okay, so Italy, for example, triggered the CFC rules following the Model A. Okay, of course, there are also some countries that they don't implement neither of these two models or both of those two models. Okay, so then we need to check case by case. In this video, we are going to focus on Italy, and Italy applied the Model A. So basically, if you, for example, if you have a holding company that controls other companies or just one company, and you want to move to Italy as a physical person, and this company it's incorporated in a country where the profit tax is less than 50% of the Italian profit tax on companies, and it's made by passive incomes, only by passive incomes, but well, automatically this company triggered the CFC rules, and Italy wants you to pay that 24% profit tax on your holding company. Okay, because we trigger the CFC rules. I hope this concept is clear. If you have any question, in the description below the video, you have the email to info@ESENtaxa.com. You can write us. We can also analyze this situation for your case. If you have a particular company structure and you want to relocate to Italy. Of course, there is a way to do not trigger the CFC rules and be completely safe. You can also schedule, in the description below the video, you have the link. You can schedule a consultation with our team, 15 minutes for free. You can basically discuss what you really need and what is your situation. If you need a real tax assessment, tax simulation, or simply we need to discuss with you what the best structure and best tax strategies to avoid to trigger the CFC rules. Otherwise, you see your foreign entity basically requalified as an Italian one because you have to pay the Italian taxes at the top of it. This is just a good news. Italy basically applies the Model A, but when it comes for passive incomes, when it has to check the second element here, the passive income should not be just the entire revenue, but it's enough that it's just 1/3 of the profit. So this is just a small exception that Italy applies for the Model A in CFC rule triggering. So, so if 1/3 of the profit is passive income, and at the same time the taxation it's 50% less, the profit tax, the average profit tax of that country where the holding is incorporated is less than 50% tax compared to the profit tax of Italy, then you apply the CFC rules, otherwise you don't. I can give you another example. So you are a person that runs a business and you have your holding company, which can be also another company that it doesn't really need to be just a holding, can be also a normal company, which control another one, okay? And this company actually is in Italy because you want to run a business in Italy. You want to run your own business, okay? This company is in a country maybe outside Europe, where the tax profit rate is like 5% in average, okay? Then you move to Italy as a physical person because you want to live in Italy. And Italy has a tax rate average of 24%. Now, if we divide 24% by 2, we have 12%, okay? And 12% is the half of 24, right? So it means that you verified this condition and you might be liable of CFC rules if also this holding is has 1/3 of profit as a passive income. Okay, so it has to be verified this condition. So 12, of course, it's bigger than 5%. So this is verified. And normally holding companies are always the one that receives passive incomes like dividends, for example, or passive from real estate income or investments, interest, and these kind of things. But if the majority of the revenue of this company, it's just more than 1/3 is not passive income, then basically you don't verify this condition, and even though your tax profit is only 5%, you don't have to trigger the CFC rules. The CFC rules is something quite complex, as you can see. It has to be verified case by case, and it has to be verified also country by country. So again, in the description below the video, our contact for any consultations, we are ready to help you. And if you like this content, if you like ESENtaxa, if you like to have more and more content like this, we try to explain to you as simple as possible. We try to make a simple, very complex concept like this one. And notification bell, please, and like button to help us ESENtaxa grow. And of course, subscribe to the channel. Thank you and see you the next time.